The steepening of the yield curve is one of the most important trends in my view for the next year. I think that's highly likely.
There are indicators that show that inflation may re-emerge. Global liquidity is ticking back up. Government spending as a percent of GDP has been on an upward trend. This may put pressure on the Federal Reserve to cut rates if the fiscal side is constrained. This is according to research from our next guest, Tavi Costa, portfolio manager of Crescat Capital, who believes that we may be heading into a renewed inflationary period, which may boost commodity prices. We'll be talking about the implications, investment implications of his research findings. Welcome back to the show, Tavi.
David, thanks for having me. Looking forward to this.
I'll be starting off by asking you a very broad question. Did the Fed make a mistake with 50 basis points, which is what they did in September, a 50 basis point cut? We spoke before September. Did they make a mistake?
Yeah, it's not that I'm trying to avoid answering the question, but I'm not sure they had an option. And from my understanding of looking at the government itself and how much interest payments is going towards, especially relative to GDP, close to 5% now, compared to other economies. We used to say, well, the dollar is the cleanest of all dirty shirts. But then looking back now and saying, well, look at Germany and Japan spending 0.5% or less than 1% of their GDP on interest payments. And most of the other developed economies, needless to say that the emerging markets are also spending way less than the US. That gives the government, or I should say the Federal Reserve, a sense of urgency to reduce rates much more than other economies. And that has to have an impact on the dollar itself. So I'm not sure that the Fed really had an option. A lot of people are seeing this as, look, I think the Fed has reduced rates before really accomplishing, the end of an inflation problem. I don't disagree. I don't think there's an end of the inflation problem, but I also don't, I think that saying that is also missing the fact that, if you were in their position, you would have to do the same. You don't have an option here. Would you keep rates at 5.5% and create a major burden for the government when you know that basically majority of the growth that we've had, particularly from a valuation differential of companies in the US versus the rest of the world, is mostly attached to the fact that we're able to spend more money fiscally than other countries, then you start reconsidering all these things. And so if you work under the assumption that the Fed is trapped and the Fed has to lower rates regardless of what's happening, then you can kind of come up with a lot of potential investment ideas or investment thesis that are likely to unfold given an environment where suppression of rates is inevitable, in my view.
Suppression of rates is inevitable. So interest rates are going to come down. We're going to talk about that in just a minute. That feeds into the next two charts that I want to show. This is from your recent investment newsletter here from Crescat Capital. Very, very good resource, by the way, for investors. Check out crescatcapital.com, link below. Global money supply has been going up according to this chart that you put together, data from Bloomberg. It looks like global money supply versus US CPI correlation there. That makes sense. Let's put these two charts together. What is the story here that these tell?
Well, money supply, by the way, this is prior to any, I put this chart out prior to anything that came out of China from a stimulative standpoint and the bazooka that came out, which only adds to that. But that puts into perspective that the level of growth we're seeing, which is about 7% on a year-over-year basis, or $7 trillion, because the money supply is about 100 plus billion. We're talking almost as much as we're kind of in the same trajectory that we saw coming out of the pandemic. And really, there's not much going on right now compared to what was happening at that time. And so when you think about this, it's not coming just the US, it's really globally. China, not as much part of this as you would think, and China may even add tremendously to this data. But the chart of CPI with money supply, I think the answer to that is, those friends that we all have that say money printing doesn't create inflation, that's the person you want to share this chart with. And I'm not trying to be, hopefully rude or anything like that. But a lot of people like to get into the technicality of what money printing really means, the expansion of money supply. It doesn't it doesn't really change the picture. The money is being diluted in a large way, and that has to have an impact on CPI, particularly when you have, this level of monetary stimulus along with fiscal, which has been something that combination of the two is incredibly inflationary. I'm extremely concerned because back in 2021 and 2020, when we came out of the pandemic and we've had all these stimulative packages coming out of most developed economies, even emerging markets did the same, and all the money creation that we've had, we didn't see the dollar actually depreciate relative to other fiat currencies. And so that to the U.S. economy, just looking at the U.S. economy alone, that was actually a positive factor that helped not to make the inflation issue even worse. This time, I am very, I remember in 2021, I came out very strongly saying, I think 10-year yields are going to go a lot higher. I'm still of that view. I still think 10-year yields could go a lot higher. I think the suppression of rates is happening on the short end. You just want to be clear of that. It's the Fed funds rate, 2-year yields, and so forth. Those, the T-bills, they're all going to be suppressed in a big way, in my view. Now, the big trend that I'm paying attention is not necessarily on the interest rate side of it, but it's the impact of that on the dollar. I think the dollar is extremely mispriced. We've had a big depreciation of the dollar versus other fiat currencies recently, and that actually has moved the other way a little bit recently as well. And I think that that's not the real trend. The real trend is that the U.S. dollar is likely to devalue much further versus fiat currencies. Now, I want to be clear as well. I've had that thesis about hard assets for a long time too. I'm not talking about hard assets at this stage. I mean, I'm extremely bullish hard assets for the near term and the long term. I am being very specific about the dollar versus other fiat currencies, particularly the ones that are emerging markets. I think that's going to have some major implications in the global economy. And we have, as investors, to think about that, especially for the next 0 to 3 years. And I'm not here to also say that this is the end of the dollar or anything like that. I'm not going that extreme either. I'm just saying the appreciation of the dollar is highly likely for the foreseeable future. And, I think that's going to be very important.
The dollar is going to depreciate relative to other currencies. Why? Because other central banks are going to be more dovish than the Fed, or other reasons?
The other way around. I think the Fed is going to have to be more dovish than other central banks. I think if other folks have not learned a lesson about currencies, is that it's a relative game. Always. It's a relative game, especially from the economy standpoint, from policy making and all those things. And when I look at that interest payment relative to GDP, this is the main thing I'm concerned about, because I cannot see this being fixed outside of suppressing rates in a large way. And if that's going to be the case here, then even the ECB and even the BOJ is in a better position than the Fed in terms of the interest rate policy. Keep in mind, Japan as a country has a much larger leverage in the system than the U.S. I understand that that's a very, very contrarian view, what I'm seeing, or very unpopular. The fact that I think that the BOJ is in a better position than the U.S., and I'm fully aware of what happened with the dollar carry trade not too long ago. But I do think that the Fed is it's really boxed in, and it's going to have to lower rates regardless of what's happening. And so we're going to get into that path moving forward. And what's going to be interesting, David, is if inflation actually really starts reaccelerating, which is my base case right here. I think that base case was a lot harder 2-3 weeks ago to call. Now you're seeing break-evens much higher. The crude prices are much higher. You're seeing most agricultural commodities much higher. We've had one of the largest increases in food prices over the last, since the Russian invasion period in 2022. So, things are lining up to a point that I think inflation could reaccelerate as the Fed is lowering rates, and the Fed is going to be forced to ignore that. That cannot be possible. That cannot be positive for the dollar, in my view.
I want to come back to the inflation side of the story, and you've done excellent research on the interplay between the Fed and fiscal policy. So we'll talk about that. But I want to focus on China's stimulus first, arguably the most important piece of news in the last couple of weeks for base metals. Just today, on Tuesday, October 8th, the Hong Kong Hang Seng Index saw its biggest daily decline since 2008 because last night, the government of China announced that perhaps the stimulus measures weren't going to be as big as initially projected. Take a look at this article from Reuters. China stocks rally fizzles as stimulus offer disappoints. Okay, Hang Seng saw its biggest. It closed 9.4% lower, heaviest fall since 2008. Comments here. Ultimately, for the rally to be sustainable, we need to see more fiscal policy and more measures to support the economy and the property market, says analysts. So the Shanghai Composite also fell. Basically, economic planner chairman told reporters Shanghai was fully confident in achieving economic targets for 2024, but his failures to detail sufficiently big or new measures rekindled market doubts about Beijing's commitment to ensuring the world's second largest economy can climb out of its most serious slump since the global pandemic. Copper today fell by the order of, let's say here, 3.5%, 2%, 3% in one day. Pretty big drop. As you know, base metals like copper rallied significantly. This was the announcement by the Chinese central bank here. So what's next for base metals? Are we still, is the China stimulus story still important after today's announcement?
Well, first, I don't think metals really rely solely on this China thesis. I think the China thesis is very much a potential upside to the story in a big way. And the reason for that is because the amount of, I just want to be clear on one thing, the amount of spending we're seeing from developed economies outside of China, whatever you want to call it, a developer, emerging market, the Chinese economy, but the amount of money on construction, on trying to fix the electrical grids and green revolution, all those things, that's not ending anytime soon. The onshoring, and clearly that is yet to drive even further demand for the base metals in particular. And you can see that as well. I mean, utilities are leading the way in S&P 500 year to date as a sector. What does that mean? Now, either a defensive sector is very negative for the economy to see a defensive sector leading, or it's just the fact that a lot of institutional capital clearly understands that all these technologies and macro trends that we're seeing from onshoring in particular are yet to feed a much larger investment towards the utility space. And if we see that, that has to also drive the demand for the metals. And so I want, that's number one. Number two, I think what's happening with China, not too long ago, China was reported actually purchases of gold, and gold was doing very well on the back of those reports. And then one month, it basically reported that, unchanged holdings of gold, and gold had a terrible day on that day. And everyone was extremely bearish and saying, look, China's not buying gold anymore. And all it did was it didn't buy it for a month. And all these assumptions are made. I don't agree. To me, this is very similar to that. I disagree with this type of noise. The Chinese market went up massively in the last few weeks. Everyone is extremely bearish and up-footed. Everyone had to change their views. And now after a massive move, it's absolutely normal to see a volatility or a volatile day on the downside. We're seeing that today. Now, is at the end of it, I wouldn't bet against it. I wouldn't bet against it at all. I used to be a China, hawkish I used to write all these papers about the potential for a Lehman Brothers moment in China years ago. I'm not in that camp at all. I think that the time to be short China was 2 to 3 years ago. This is not the time now. Things have been cut in half. Some other things are down 80+% already. And if you don't understand that as an investor, I think you're missing the point in a large way. So I fully have this China thesis as a potential for other things like gold and base metals and others. I do think that the Chinese economy or the Chinese government is serious about stimulating their economy once again. And while I don't see this being what is highly dependent on the base metals case, I think it could be a very important upside, even for other emerging markets. And so you're seeing this sell-off in crude, a sell-off in a lot of other things. And if you look at it, technically speaking, crude is actually right in a support. It would make sense to have a weakness right at that level that we're seeing right now. Now, those types of, I shouldn't say support, resistance. those types of resistances are usually not, very strong. You tend to see a big break out of those. And I would be betting on the other side of this. I actually think that inflation will reaccelerate. I think commodities would do much better here in 3 months from now. And that can change quite a lot, this dynamic that we're seeing on a day like today. I think those things are quite normal if you're an investor and you follow these things. And I want to say one more thing. Every thesis that you have, that you come up with, will be challenged at some point. Everyone. I mean, I've had my own thesis that have been challenged in the past. How many people told me silver would never rise? How many people told me gold would never rise? And trust me, I've had situations with silver trading $18 and I had to defend my thesis. Well, those folks that came out recently and said China was a trade to be in and they got it right, now they're being challenged. And what do you do in that position? Do you just get spooked and out of the thesis, or do you have the basis and the support to really, rely on and add to your position on a day like today? Now, I'm not an investor of communism. I'm not an investor of those companies at all. I want to be clear there too, but I would not bet against it. And I do think there's ramifications to the global economy. And I think that's going to be very positive for emerging markets. So I'm a buyer of emerging markets. And I think that's really the big trend ahead of us.
Going back to your thesis here, liquidity is going up, stimulus from China and stimulus from other central banks. So immediately, what are we looking at in terms of investment implications? Do you like emerging markets, commodities? These are your highest conviction calls right now for bullish assets that will react to this stimulus?
Yeah, I have, I've been very consistent over the years in those ideas. My ideas have always been, we've been in a entrenched inflationary era, where central banks worldwide are in a very limited position to fight those trends, and therefore are going to have to allow them to continue infiltrating the system. And ultimately, it drives capital back into things that have been neglected for a long time, hard assets being one of them, and also emerging markets. Now, of course, I have near-term of views as well, and I think energy looks very attractive. I think a lot of people are not counting on the idea that energy can break out and change quite a lot the macro setting here, and I think that's a real possibility. There's geopolitics that can play into this as well as a premium to energy prices, but also natural gas, oil, all those look extremely attractive. Other implications that I think are important when you have the suppression of interest rates on the short end, but you also have inflation running, somewhat freely, you can have a major steepener of the yield curve. And so the steepening of the yield curve is one of the most important trends, in my view, for the next, call it, year. I think that's highly likely. We are highly likely to see a steep steepener or a steep steepening of the yield curve. And so those are important trends that are, also still, likely to unfold here.
Let's talk about that steepening of the yield curve, the most important investment trend of the next year. Why is that going to happen?
For two reasons. One, as I said, I think the Fed is trapped and they're going to have to reduce rates more than other central banks, and they're going to have to act quickly despite what's happening. And that doesn't mean we're going to see 50 basis points to more or anything like that. I'm also not saying this, but I think that the trend of rate cuts is here and it's here to stay. And so, this is my view on the short end. So short end is likely to actually go lower. And then on the back of that, we're seeing inflation actually reaccelerating this, with the Fed acting that way, but also with more stimulus globally on the money supply front. We're seeing commodities starting to trend higher. If you are of that view that inflation is reaccelerating, you're probably of the view that the 10-year yield will be challenged. And the other thing that I think not enough people are covering, and they were covering a couple of years ago, and now this thing has been sort of on the sidelines, has been the issuances of treasuries more recently on the long end are starting to increase again. And I think that drives supply much higher, drives yields much higher as well. So I would not want to be long the 10-year treasuries or the 30-year treasuries. I do think those yields are going a lot higher. And so if that's the case, you have a short end that is limited and is likely to go lower. The long end is got a lot of upside. So that means steepening is highly likely. Plus, historically, when you have a deeply inverted yield curve, what do you see on the back of that? Abrupt moments where the yield curve tends to uninvert and in a very significant way. And so I don't think this time is different. I think we're going to see that once again.
When the 10-year minus 2-year yield curve steepened in the past, which assets have historically done very well?
Oh, that's a good question. I actually did a full research on this, looking at, I created an indicator, and I actually did a presentation at the IMF about this, which is I was invited to because I created the percentage of yield curve inversions. So instead of looking at separate yield curve spreads, like the 2 versus 10s that you referred to and others, that a lot of people tend to look at, I decided to actually create a little bit more comprehensive way of looking at this and looking at all possible spreads in a yield curve. There's about 45 possible spreads, and then calculating how much percent of those yield spreads are actually negative. And when you go above the 70% handle, you tend to see a recession. And if it's not a recession, which actually happened, I think, one time, where equity markets, did well despite all this. But one trend that is very clear that it tends to happen more often than not, and not only that, but the performance is very robust, is that the gold to S&P 500 ratio tends to rise significantly after those, very large amounts of inversions begin to uninvert. And so we are at that process now. If you look at the gold to S&P 500 ratio, it's been going higher, but not massively yet, because the equity market has been holding up well. And, gold has been doing tremendously well. I mean, with the surge we've seen in prices is really what's been driving this ratio recently. But there's a lot more to happen here, in my view. And so I would be surprised if we don't see the gold to S&P 500 ratio be substantially higher in call it 1 to 3 years, because of this correlation it tends to have with the uninversion of the yield curve. And so that's usually the big sign. Now, it depends, to your question, it's going to depend on a lot of things. So if you are in the deflationary era, Treasuries is a good bet. And so in the last 20 years or so, every time you are in the position where yield curve is extremely inverted and it starts to uninvert as a recession unfolds, you want to buy Treasuries. If you are in a more inflationary era, you do not want to buy Treasuries. You're going to get in trouble. You want to actually buy gold. And so it really depends on what type of regime you're in. And now I have my opinion on that. I certainly believe we're in an inflationary era. And I think you can measure that in many ways, particularly how, commodities have been trading. We can get into that. There's kind of a rotation dynamic that we tend to see from when you're in a commodity cycle in a very inflationary era. And in my view, this gold to S&P 500 ratio may actually work even more than we've seen in the past. So I'm paying close attention to that because of this, development in the yield curve.
So we're going to be in a bear steepener versus a bull steepener, meaning the short term will fall faster than the long term, but that's going to be happening into more of an economic decline. Is that basically your thesis?
I am agnostic about bear or bull steepener, and okay. I think that
interesting.
You don't really have to answer that question unless you want to answer that question. But I don't think you need that answer. I mean, we have that trade on in our portfolio, and we don't have that. I don't have that answer. I really don't know the answer for that. And I don't have a strong view because I don't know which one is going to move more. Honestly, if the fiscal side becomes a problem and the 10-year yield moves a lot higher, I'm sympathetic with that view. What if we see labor markets? I know we've seen some data recently, unemployment rates and others that don't support further cuts. But let's see we do in a month from now. And, a big change in the narrative on the labor markets front. And now justifies the Fed to cut much further, then the short end moves more than the long end. So, I don't really need to answer that question because I actually think the trajectory of both sides or not both sides, but the spread itself is moving higher regardless. So what we do is we keep always, we have a duration adjustment of the position of that idea in a portfolio. And every week or so, we try to, kind of match that duration, because the duration, the position would change because of the movements we tend to see. So as long as we're hedging both sides and that spread continues to be, balanced in the portfolio, then that's, I think that you can be agnostic to that question.
Actually makes a lot of sense. I want to flip back to my screen here. You have in your report, you said that your primary concern, however, is that the rising share of interest payments and entitlement spending pose a serious challenge to sustainability of this dynamic. I think you were referring to the role of monetary policy here. Such non-growth oriented expenditures have surged significantly. So by non-growth, you mean spending on things that aren't infrastructure, things that are productive. You're just spending things on interest payments on debt, for example, and that spending from the government has been rising sharply per your research. What does this mean for capital markets, this chart?
Yeah, I usually, my letters are kind of long and I kind of build on them over time. And the prior letter was about a research I did about, the average fiscal spending we've had since the global financial crisis across the globe. And clearly the US is the one to spend the most. It makes sense. We're the reserve currency. We can be less disciplinary than other economies. It's what comes with territory, right? And so that's what we did. We meaning I'm Brazilian, I'm not American, but that's what Americans did. They spend more money on the government side. That created growth on the back of that. That created a divergence of valuations of equity markets in the US versus other places. Imagine spending more every year than other economies on a relative basis. Kind of explains why you have such, frothy valuations in the US versus other places. So that's number one. Now, when you dive into that 8% annual spending that we see relative to GDP every year, right, in average, one important aspect of that is that the known growth. Now, how much of that is known growth? How much of that is entitlement? A lot of people say that, entitlements is eating the lunch of spending. It's not. I mean, it is, but it's not as bad. I mean, it's actually been very stable over the years, believe it or not. Yeah, I ask everybody to look at that data. Look how much entitlements is being spent relative to GDP over the years, and you will see that line has been going sideways recently. Now, what's not been going sideways is interest payments relative to GDP. That has been surging, and now so you're looking at that 55% of U.S. spending is known growth, because that's entitlements, that's interest payments. Now, 20% of that is interest payments, just to give you some sense. So it's a quite significant number, and it's only going to grow from here unless we take rates to zero tomorrow, which won't be the case either. So, I do think that this is a problem, and it comes down to two potential solutions if you think about it. One, you can suppress rates so the interest payments can decline, and that's one solution, and I think that's going to be part of it. And number two is let's spend more, so that known growth aspect, while may grow over time, you still have that other part, the growth aspect, that will still be coming in a more significant way over time as well. So let's say instead of spending 8% of, or call it 6% of GDP on fiscal spending, on deficit, you can maybe be spending 8%. So, but those things are highly inflationary, both policies, and I actually can see them actually working together, not separately. We can see a suppression of rates with more spending. But what's funny about this, David, is that if we see suppression of interest rates, that just means that the no growth aspect, that 55%, may actually shrink because you're suppressing interest payments relative to GDP. So you have to think that way. Monetary policy is becoming more and more a tool to allow the government to free up some of that burden from the debt front. And it's changing even the mandate of the Fed itself, which used to be, let's try to create stability from the inflation front, labor markets, and the real, in my view, the real issue here is how do we pay our bills tomorrow from a government standpoint. And so it's changing the dynamic in a big way. And I think, again, it goes back to being very, very inflationary, because all these solutions or potential solutions to the problem, they're not really fixing the problem. They're just, I guess, creating other imbalances. And inflation is a big one. So I view this as a problem. And I do think we're going to see a lot more inflation. And this is not the end of it. And it's interesting that policymakers try to justify these changes in interest rates and other things by saying that, inflation is back to normal levels, when, first, that's really coming from government data. But secondly, you can look at commodities, and commodities are not, I wanted to explain this earlier, but commodities are in kind of a rotation dynamic right now. You can see this clearly because every month there's one commodity that is the flavor of the day, right? It's like, oh, now it's gold. Gold price is surging. And then the next, 3 months ago was copper. And then it was orange juice. And then it was energy. You saw oil and natural gas back when Russia invaded Ukraine. And then you saw lumber prices coming out of 2021. Ammonia prices went up a lot. So you can kind of see they rotate, and that's usually a sign you're in a commodity cycle. So I would not play against that. I do think that's a much longer trend than most think it will last.
You've identified here something that I've noticed as well, which I find very interesting: the relationship between gold and base metals. You used copper here as an example, and you wrote that the recent rally in gold prices that's been happening all year long could serve as an early indicator of what could be on the horizon for base metals. Since when have they started moving together in tandem? Yeah, logically that wouldn't happen, but here we are.
Well, it's interesting because I think all of us try to be, very specific when we look at copper and say, well, it's a very cyclical commodity and tends to move more as an industrial metal. Therefore, it moves more with the economy. And, when it falls more than gold. And when it rises more than gold. Those things are all true. I'm not here to say they're not true. But clearly, if you were in a gold cycle, you're probably in a copper cycle. Look at that chart. And I think it's a reflection as well of what happens a lot in markets, where the easy capital or the easy decisions are made with things that are safer, right? First. And then as people feel confident, they start spreading the risk and going up on the risk curve. So in other words, it's much easier to take on a gold position at first than a copper position. But when gold starts moving, the immediate reaction of any investor is like, are there other metals that could move along with that? And then you start doing your research in other metals, and usually they're part of the same cycle. If you're an investor in the gold space, if you're a miner, a lot of the gold deposits also have copper. A lot of the copper deposits also have a lot of gold. A lot of the gold deposits have a lot of silver. So they're all kind of in the same phenomena. And then you think about what really creates a cycle for commodities. At the end of the day, if you could pick one thing, what is it? And it's usually CapEx. It's capital spending of the producers. When producers are spending a lot of money in aggregate, that's usually the end of a cycle. When producers are not spending enough, giving money back to shareholders, are not doing acquisitions, and so forth, that's usually the sign of being at a bottom. We're probably there, right? We're seeing some acquisitions, and usually they're happening between majors, one major buying another or merging with another major. But we're not seeing any CapEx increases. CapExes are still extremely low relative to history, particularly if you divide it or you adjust it by GDP, which it should be. Right? $10 million spent on the ground today are not $10 million you spent back in 2008. They're very different. Those dollars will not get you the same that you did back in 2008. And so I think it's all kind of linked. And the same way goes to this, ridiculous notion that is completely unsupported by history, that if we see gold prices this time rise, which has been happening, we're not going to see the miners actually perform well. I've never seen this throughout history. I don't think that's supported at all by data. And if we do see gold prices going a lot higher, which I think we will, it's just my opinion, I think that the miners will also follow, and also base metals, copper, silver, cobalt, zinc, manganese, you name it. Most metals should be moving in the same direction. And ultimately, if the underlying metal price is moving higher, then it means as well that we're likely to see better fundamentals for most mining companies.
So I've heard this theory from some people, and tell me what's wrong with this assumption, what the underlying assumptions behind this theory. Gold going up could signal more volatility ahead, more weakness in the economy, perhaps. Basically, gold going up is a barometer of weakness in risk assets, which could then signal slower growth, which means bad news for base metals like copper. Basically, gold going up should mean copper going down, a divergence from your chart. What, if anything, is wrong with that?
Well, David, I would, to those folks that have said that, can you please forward this chart to them? I think that would be important. I think you should ask them the question, what happened in 2000? Why did gold rise so much? And copper also was rising as much as it did during that period. Some people will say it's because of China. China was driving both markets, really. What about today? What are we seeing? Have you seen how much spending we're seeing in construction? Or have you actually taken the Inflation Act and how much is being spent, even from the government, forget about private, and compare that with times like coming out of World War II, when we did, nowhere close to what we're seeing today. Even the Marshall Plan, which was a global plan, not in the U.S., was smaller than what we're seeing now, adjusted for inflation or relative to GDP, which is insane. And so the amount of money going into construction is also likely to drive copper prices. And I think that the whole idea of copper being more industrial and also having this connection with economy is true. It's very, very true. And potentially, this is the beginning of an era. Now, maybe this whole chart is wrong, and that divergence we're seeing is the beginning of a new era where copper goes one way and gold goes another way. That's not what I believe. This chart actually, if you go back to the 70s, was the same thing. And usually this is just the case because pension funds and other large capital allocators, gold has a potential to be signaling weakness ahead if it's rising. Not every time. Look at the early 2000s. When was that? That was the tech bust, right? And still, copper did well. Look at that. Copper was still, going up. It actually had a little bit of a lag, which is the whole point of this chart, right?
Yeah.
It's the arrow that is a little bit ahead of it, but it went up, and it went up a lot.
I'm just scrolling back to, you're absolutely right. Good relationship between copper, which is right here, the purple line, and then gold, the bar chart. Obviously, there have been periods of divergence, but if you just scroll back into 1 year increments here, for the most part, except for 2019, they've held on pretty well. So
now, would it shock you if you put agricultural commodities in this? It will also show the same link.
Yeah.
And
interesting.
Is that shocking? I mean, you start thinking about it from just the rationale of putting capital into gold, and then gold starts going up. You start thinking about what are some other hard assets I should probably be considering. Should I put 1% of my fund into agricultural commodities now that they're so cheap and they haven't moved as much as gold?
Yeah, here's wheat. Moving quite well with gold.
Yeah, so there's...
this is interesting.
And so definitely there's a link in these commodities, and they're usually all aligned. So another point that is important. Remember that early 2000s all the way to 2011, where gold prices basically went one way up, despite the decline back in 2008, which was brutal for investors. But if you're sticking with the trend, you did very well. But another thing that tends to happen when gold prices are rising, emerging markets, and there's a reason why we tend to see at times every couple decades a certain type of leadership in the market. Sometimes it's technology, and it's not forever. And then it changes to banks, and it could change it to emerging markets. And then it goes back to U.S. companies are leading the way to the upside. And look, I mean, back in in the early 2000s, if you bought Ibovespa, which is a Brazilian index of equities, the most boring way to buy Brazilian equities, just buying the index, it went up 18-fold until 2011, right? So that's like, those are the types of returns you can get if you're being able to identify these trends early. And I think that's the type of opportunity we can have here in a big way. So, yeah.
I want to finish off. We have a few minutes left. I want to finish off on mining stocks here. You have here an excellent chart. Cash flow of the gold sector and gold companies. Of all the sectors of the S&P 500, it looks like this one has the highest cash flow margin. Is it by the last quarter that you're looking at? Yeah, as of September 17th. The GDX has just started to outperform the S&P 500. Year to date, it's up 25% versus the 21%. But the outperformance is recent now, Tavi. So what's next?
Oh, well, I think we're nowhere close to what we're likely to see with the mining industry, in my view. Level of skepticism hasn't changed. A lot of people still think that, the overwhelming view out there is that gold, yes, I agree with gold. Of course you agree. Gold is going up already. It's so funny how people tend to miss these things. But I think that the mining industry has a lot of leverage to metal prices. And leverage works both ways, in a good way and a negative way. If you catch the wrong wave of gold prices and metal prices in particular, you're done, right? It's going to be a very difficult period to be in the mining industry. If you catch the right wave where things are going up, then yes, costs will also caught up to will also rise at some point as well. And there's certainly a degree of that linked to gold prices too, but they do have leverage. And you start seeing institutional capital come in, scalability of projects. Things can change quite drastically. The whole reason of this chart is to kind of prove the point that there has been fundamental improvement in this industry, and margins have been improving. It's needless to say that gold prices have been rising to a degree that we haven't seen in history, and other metals are yet to follow. So, in my view, the next wave here is going to be very much driven by the mining industry. And so I'm very focused on this because gold prices have already showed the direction. And I think that the next one to also benefit from this is the mining industry. And, we're seeing general investors become more and more interested in the space. But the lack of knowledge and understanding of this whole industry, I think, reflects on the lack of efficiency that we have in how we price this securities. And, inefficiency is also a cool word for opportunity, in my opinion. So this is why I'm always, there's two things that I'm really interested for the next, decade. One of them is, three things. One, try not to be too cute with markets, right? I mean, I don't know when gold prices are going to go down 5-10% or copper or and not just me, but anybody. Now, I have a strong view that gold prices will be substantially higher 5-10 years from now. If that's the case, there's two trends that I'm very focused on. Mining, I think mining will do very well. You could see energy, you can see other things do very well, but I think mining is going to be one of the main ones. And number two is emerging markets. And I think those are extremely mispriced today. And, talk to me in 5 to 10 years. If I'm wrong on that, then, I'm happy to admit and move forward. But that's really where my allocation of time, capital, attention is really towards at this point.
Well, it's been a great year for commodities and precious metals in particular. So you've been correct on that call. So we don't have to wait 5 years to congratulate you. You've already been right on that. Good stuff, Tavi. Thank you always for your updates. Where can we learn more about you, and what can we learn from your work?
You can learn more about me on Twitter at Tavi Costa, and you can see some of my posts, and also at crescat.net, where you can see some of our research pieces that we put out there as well. But thanks again, David. Always a pleasure speaking with you. And look forward to speaking with you soon.
Yeah, thank you very much. Thank you for watching. Don't forget to like and subscribe. Follow Tavi down below.